Well, thanks, folks. You'll have to bear with me for the next, I don't know, 60 minutes, 45 minutes, 90 minutes, whatever Rishabh and team decides. So what I thought would be useful is to kind of talk about the main components of ESOPs. I know most of you know about it. Most of you know its value. But I think what's generally been missing here is some real wealth generation stories, which you can take back into your team building process in some way or the other, because the intention of ESOPs is to share wealth that all of you guys are going to create in building the companies that you're building. So I'm going to go through a few things. I've broken it down into 4 components. So we generally call this full stack ESOP. There are 4 parts to it. One is the compensation design that talks about who gets and how much. There is structuring and compliance, which is all legal, accounting, taxes, and all the stuff that you wish weren't there but are there. There is the administration part of this, because this is unlike any other form of incentives. This requires active administration. So there are components related to that. And finally, liquidity. And why are we doing all this? It is to share wealth. If you don't have a framework for building wealth, then this as an instrument becomes pretty useless. And that's why we keep hearing the word paper wealth. And we've heard it for way too long. And the idea is that hopefully it turns into a different kind of paper, which has, Mr. Gandhiji printed on it, that could be used for more things other than what you use paper for. So I'm going to go through these 4 components, fairly quickly. If you guys don't like the pace, whether it's too slow or too fast, and do butt in and let me know, and I'll kind of change accordingly. But in general, the most important part of it, where people I've seen struggle, is how do you decide what to give and how to give and so on. So when you decide cash compensation, there are largely 2 things that come into play. One, what is the market compensation for whatever role you're trying to build? And second, what is it that you can afford? So somewhere in between, or leaning towards one of them, you end up doing fixing your cash compensation. And also there is a lot of data which can be broken down into specific roles, specific cities, job description, and so on, which will help you arrive at what is a good comp for this particular role. Now, nothing of that kind, unfortunately, exists in ESOP. But the good thing is, over the past few years, we've been able to build something looking at various outcomes. And largely, some of these things are influenced by what happens in Silicon Valley. But we've been able to bring it down to something which is a little more valid for the Indian audience, so to speak. So one thing to remember is one size doesn't fit all. So you can see a very wide range of pools, which is about 5 to 20%. And I'll tell you why it is 5 to 20%. And that's the reason why it's that big range, is that it needs to be customized. Most often, you probably would have heard VCs say, whenever you're in doubt, just go to something like between 8 and 10, and that's good enough. Well, that is good enough as a starting point. It generally needs to be tailored into what you do and what kind of team structures, do you have. The earlier you set it up, the better it is. And from a founder's perspective, it's very, very simple, because ultimately, remember one thing, any pool that you create is coming out of your share. Nobody else participates in giving up this equity. Sometimes as investors come in onto your cap table, and whenever the ESOP pool needs to be expanded, everybody else gets diluted, including the investors who had come in. But by and large, the biggest size of the pool comes out of founder's own pocket. So, and it's important to kind of realize this, but not to, use it to negotiate. The point is not to say just because it's coming from your pocket, let's keep it as low as possible. But the point is that it is a wealth that you are wholeheartedly trying to share, and it's being done because you need these people who are going to be your partners in building the company. Again, there are a lot of rules in terms of, and I'll go through some of them, of do you do it for everybody in the company or to some specific group or department. All of that, again, is a case-to-case basis, though there are some guidelines. Largely, you'll have to tailor it to what you're doing. Most important, in the early stages of the company, everybody tends to think of ownership as percentages. I'm going to give you 1% of the company, 0.5% of the company, and so on and so forth, right? So there is nothing more dangerous than that. It's really important to understand what that percentage means at what stage, both from the founder as well as the person who is receiving it. And many a times we see a lot of issues because these two, even though you agree on a percentage, you don't really agree on what that percentage means in terms of timeline. You may have meant percentage as of today, somebody else may think it's percentage, when a company raises a financing round. It could mean completely two different things. So there are some, and as we go through this, I'm going to point out some red flags every time I talk about some of this. And in this case, again, like I said, avoid issuing any random percentage-based numbers. Don't give numbers without giving, or don't give numbers or percentage without giving a vesting schedule. And don't give percentages just because somebody is an early employee. Because it's possible that you may have very junior employees that you're hiring from, in the beginning. So you need to kind of take into account a lot of these factors before you decide your primary strategy. So generally what we call CTC-based allocation is typically how the industry is doing it nowadays, and pretty much how industry has been doing it in the US. It's assumed that you're going to have a cash-based compensation, which is fairly thought out and said, okay, between what the market demands and what you can afford, here's a number that you're doing. Now, every time you give an ESOPs, you try to do it as a multiple of that cash-based compensation. And the reason why this is recommended is kind of it anchors your value to something. Otherwise, these percentages, like I said, don't mean anything. Number of options don't mean anything unless it's connected to a particular cash formula. And since salary is the only other component that is already fixed, you are better off connecting it to a salary-based structure. And again, a lot of this depends on how your organization structure is. You may be setting up a 50-member organization. Somebody else may be looking at setting up a 250-member organization. So you need to first have an organization structure, look at what roles the founders are going to play, what roles have to be bought from outside, and generally, where are you going to hire these people from? Because normally in startups, when you say market salary, the market salary does not mean any sense. What is market? What is the definition of market, right? Somebody will compare it to a Google salary. Somebody will compare it to, a very small company type of salary. So our definition of a market salary, for a startup is, where are you hiring these people from and what are they getting paid there? So if you are, let's say, a chip company, and if you are going to hire from the NVIDIAs and the Intels of the world, guess what? That is your market salary. If you are a SaaS company and there you have the freedom of hiring from a lot of smaller size companies, and that becomes your market salary. So once your market salary is identified, once your org structure is identified, and then you can start to look at, some sort of a framework in which you can say, if I've given you 1 lakh rupees in cash, should I be giving you 50 lakhs worth of options or 1.5 lakhs worth of options? So anything, once you have one number nailed, you can try to build ESOPs as a supplement to that. Again, some red flags. Don't do this randomly. If you don't have an org structure, first build an org structure. And don't do this if you don't know what a valuation would look like. Sometimes if your valuation is not there, try to look at what a peer valuation would be and try to anchor around that. Because here, remember, we are talking about absolute numbers in terms of cash. Telling somebody I'm going to give you 1,000 options, makes no sense if you don't connect that to saying that 1,000 options today is worth, 2.5 lakhs and tomorrow it will be worth 20 crore, right? So none of this is possible without having a valuation. So kind of make sure either it's your valuation or a peer valuation, you have some number in mind before you can do a CDC-based allocation. The percentage-based allocation is here to stay, but that's not for everybody. So the rule of thumb is generally you don't do it for more than first 5 employees. And this first 5 employees, I would say first 5 critical employees, don't count interns and juniors and so on in that allocation. And we have never seen in India anybody give an employee more than 1%, unless you are bringing an exec, a senior VP, an executive VP on board at a later point in time. So the typical early stage first 5 employees are in the 0.25 to 1% range, largely closer to 0.25. 1% is an exception. A good rule of thumb to keep is, the first 20 employees cumulatively should not cross 2 to 3%. And again, a lot of these numbers are arrived with a lot of care, a lot of data. You will see outliers, but here we're not talking about outliers. Sometimes single founder companies, you're getting a co-founder on board right in the beginning. So it's possible that you may have to give 10% of the company. So in these cases, even though it is considered an ESOP pool, generally it's broken down into a separate pool called a founder pool, and you build it from there. So anybody who asks or demands like a 5% in an early stage of the company, you have to view them in the lens of a co-founder. And if they're not co-founder material, then you've got to look at, how else can you compensate them if you want them. Because remember one thing, once you provide ESOPs, there are a lot of challenges in getting them back. So even though we'll talk about it in the later stages, but generally errors in ESOP allocations given on a percentage basis can be very, very expensive. So you literally have to, do it more like an exception, talk to other advisors and your board members and so on before coming up with a percentage-based allocation. So we always recommend a multiplier strategy. Bring, once you build your org chart, normally org charts, we break down into departments. There's a product department, there's a business and operations department, right? So you have to figure out what is the core department for your setup. Most of the tech-driven businesses, usually the product will be the key thing. And when I say product includes product, design, engineering. Operations includes all the operations material. It could be internal operations, it could be external operations. Business basically is marketing and sales, business development and sales. And you've kind of figured out a way to map levels. Some of this may appear like a overkill if you are very early, but I would still recommend you to do this because it kind of sets up a lot of other things, clearly. And somebody like Ketan can really help you put all of these things, together. And then from that, you can go and set up a multiplier range, based on, your company and your sector. So in this, I've just given you an example. So if I say P1 and there is a multiplier of 0.75 to 1, and it maps to level 10. So it is the senior most product non-founder role. And if you look at this example, it basically tells you give them any 75 to 100% of their salary in options. So these are not real numbers. I'm just using that as reference. But typically, this is how you set up a multiplier strategy. Once you have your org chart, once you have your department level grouping, once you have criticality assigned to each department level grouping, and then you go and build a multiplier range. So it kind of becomes scientific of how this is done. And there's a second reason why this is extremely important is, remember, whenever you have a pool, you want that pool to last a significant amount of time. you cannot refresh the pool every year. You cannot change it even every 2 years. You cannot change the pool. So you are essentially taking a look at what do I have today? What is my hiring plan over the next 4 years? And then say is this pool enough for that hiring plan based on the type of company I am? And a lot of these things may change, but that's okay. At least you have a method to this madness, rather than, doing it ad hoc. And again, one red flag, don't try to create a level for every position. That's not the idea. The idea is try to combine things, try to put similar roles, and so on and so forth. Again, like I said, somebody very experienced in people management can actually help you set this up. And this is required irrespective of whether you do it for ESOP or not. Anyway, it's going to be required for your regular operations. So it's a good idea to build one and use some mechanism to connect that. So one thing that keeps coming up here is, we don't have cash, or we can't afford to give cash, and shall we give options instead of cash? Now, this happens all the time. But again, the idea here is not to hire somebody under pressure, or not to allocate somebody higher percentage of options under pressure. If you think the person is really key, by all means go for it, but do not do this randomly. I mean, you will see me repeat this almost every other minute, saying don't do this randomly, which essentially is, even though you may be not following the norm as such, make sure you don't do it randomly. And there is a reason that is specific to your case, and you can kind of justify it first to yourself and then to the rest of the team as well. What's really important is whenever you are giving options instead of cash, some people also come back and tell you, could the cash be topped up at a later point in time, and so on and so forth. These are all
Satish, we had lost your voice for a bit. Just repeat that.
Just the last problem.
Last
minute.
It was very clear. You guys
Okay.
must have had a network issue. I don't know if anyone else faced that.
No,
Are you able to?
It was all clear actually.
yeah, it was all clear.
Yeah, please go ahead.
Okay, so I don't know where it got chopped off, but I'll just kind of repeat. I think what I was talking about is whenever you're giving options instead of cash, again, don't do it randomly. Make sure it is limited to very few people. You also understand what your runways are, and be very transparent about this, because this again leaves a lot of room for confusion. Don't tell them that, oh, I'm going to give you this X percentage now, and then once I get money, I will do some buyback and all of that. So one of the hardest things in this is to provide intermediate liquidity. So do not promise anything that you cannot deliver. And most of the times we have seen early stage employee dispute is in this area, where some promise was made, there was an understanding gap, there's an expectation gap, and you get into trouble. It's a good tool because most often you will not have cash, and options are something that you think you have, and it's good to use it, but use it the right way. One of the key things that comes for most early stage companies is, there are consultants and advisors. Again, these are very experienced industry people. You can't afford to bring them on board. They won't come as employees, but you need to compensate them, and you can't cash compensate them. So unfortunately, in India, there are not too many options of taking care of consultants and advisors through ESOPs very well. Indian companies cannot be given ESOPs because they're not employees. So usually we do a different structure called a stock appreciation right, or a phantom stock, which is cash settled. Now that comes with a whole bunch of limitations. I'll kind of explain that a little later on. And if this advisor is outside the country, you have FEMA coming in. So you have additional complications. Indian advisors may have GST issues. It's not tax efficient, but you still can do something. The only warning sign here is, do not get into any cute structures to bypass FEMA and all of these guys. So one of the things as entrepreneurs, we are generally told that, you need to kind of break rules, right? But when it comes to regulator, whether it is two regulators, most importantly in India, RBI and SEBI, don't try to play cute with them. So this is, you will see, for example, if you're a transportation company, let's take an example of ride sharing, right? Uber could come out with some product when the RTO did not allow it. Those are things that are edgy, but still okay because the entrepreneur is pushing the boundaries on some cases. But when it comes to financial products and when it comes to SEBI and RBI, this is not something that's going to work. You have to make sure you are conservative. And even if there are law firms and other advisors telling you, hey, we can do this, some crazy combination of this and that, I would advise you to stay away. It's easier to explain to these people saying, we are trying to compensate you within the structure that is allowed and see what can you do inside that rather than trying to find some workarounds. There is also something that we have seen that is happening quite often, which is appointing these advisors as directors. Because according to company law, you can give stock options to directors. So sometimes people think that, okay, we'll make these people a director and then give them options so they get qualified. Well, if it is a bona fide board member or somebody whom you want to bring as a board member, it's well and good. But do not do this just to provide the advisor ESOPs. And I have recently heard that, this advice is quite rampant in the industry. People are saying, just appoint the person as a director so you can give them options and so on. If it's a genuine case, by all means, go do it. But also remember that once the directorship ends, it's equivalent to treating them as the employment ending. So your vesting and everything will have to stop. So you cannot make somebody a director, give them options for 4 years, and the director resign after 6 months. All of these things are not going to work. And the reason I'm specifically talking about this is I'm kind of hearing this in the market from many sources that people have done this and so on. My personal advice is to, avoid this. Don't take on RBI, don't take on SEBI. And as much as possible when it comes to these things, be on the right side of the law. So who cannot be given ESOPs? Promoters, all of you are promoters of your own companies. So typically, unless you have a DPITT registration, you will not be able to get ESOPs. And this is not an issue at a very early stage, but becomes an issue at a very late stage of the companies where you've been diluted and the investors wants to top you up and they say, okay, let's try to see if you can give it through ESOPs. So it's a problem that you guys don't have to worry about, because I'm not too sure who are all online, but I don't know if anybody is in the later stage founder. There is again an advice that reclassify yourself as a non-promoter and you can get options. Again, this is trying to be cute. One of the biggest cases that happened a few years ago was Paytm. Vijay Shekhar Sharma, just before the IPO, classified himself as a non-promoter, got ESOPs, and the company got listed. And then finally, SEBI stopped in and he had to return about 1,800 crores worth of ESOPs. So I'm just giving that as an example of when things go wrong, they really go wrong big. So don't even think of trying to do something unless you are not going to be a promoter at all. If your reclassification of promoter basically means that you are no longer a promoter, then it works fine. But you can't still be a quasi, a promoter and then not classify yourself as a promoter. Directors can be given, but there's some restrictions. If you already hold more than 10%, you can't be given. If you're an independent director, you can't be given. There is employees of group companies. Generally, when we say we can give options to either employees of a company or employees of subsidiary companies as well. Now, there is this crazy definition of group companies where two companies are not really do not really have cross-holding, but the promoters will be common. So in these cases, you really cannot give because the promoters are common. You can't give options of one company to employees of another company. So just be aware of some of these things. These things always show up as exceptions, but whenever it goes wrong 100%. So I'll stop there for a minute, and if anyone has any questions.
Hey Satish, Ranjit here. Can you cover ESOPs out here?
ESOPs, I didn't intend to cover as such, but okay. I can talk about it towards the end. I mean, I've not put any slides together, so I can cover it towards the end.
Sure.
Number two,
thank you. Either way is fine.
Or I can, if you have any specific questions, then I can take those specific questions as well. Because ESOPs again is not something that's a one size fit all. Like I was saying, I'll just complete the conversation a little bit. If you are not a promoter, then technically even a founder is a regular employee. So you can be given ESOPs. There's absolutely no problem with it. The only issue would be most of us start out as promoters of our own companies. At some point in time, if you don't step out of that role, then you have an issue. There are other ways in which ESOPs are given, which is more given in the form of share allocation, not necessarily a stock option as well. So I'll talk about it a little.
Got it. Sure. No, thank you. Thanks, Satish.
I'll just pause for a minute or so. Any other questions on?
There is a question from Dipesh.
Hey, hi Satish, Dipesh here.
And sorry guys, I will not be able to see the chat window because I'm on full screen here. So if there's something on the chat window, somebody will have to just read it out to me.
Yeah, hi Satish, this is Dipesh. One question: can the vesting schedule be different for different employees? Let's say I have a key employee and the employee has been with me for long, right? So I want to have a different vesting schedule for him. And then someone who has just recently joined, he can follow the normal 4-year vesting schedule. Can those kind of things?
I'll cover that in the structuring. I'll cover that now.
Okay.
Hi Satish, Jayant here from Highland. One doubt that I had is, so typically, as you already mentioned, every startup, whoever is the founder, is actually the promoter also of that particular company. And since we are DPIIT recognized, so a promoter can still take ESOPs. But at the same time, as a promoter, I'm also acting as the director of the company, and I obviously hold more than 10%. So is it like both have to be qualified, or since I'm a promoter of a DPIIT startup, even though I have directorship and holding more than 10, that doesn't matter, or how is it?
No, the director greater than 10% holds. The promoter break you get because you're DPIIT. But because if you're a director holding 10%, then you will not be able to get options.
Okay, got it. Thank you.
Okay, so let me go to the next part, which is structuring and compliance, and some of this is legal, so bear with me. So your ESOP policy is actually a legal document. Okay, it's not an internal document as in your other HR policies. So this is really, really important because unless your ESOP policy is approved by the shareholders and the board, you cannot give options to anybody. So this is really, really important. A lot of times when people give promises to employees saying you will get some options or you will get a certain percentage of the company, that date from when you get would be connected to the date the shareholders have approved your ESOP policy. So it's very common where we tell people that they have so many options even before a policy is put in place. But when you actually put the policy, you can't give them from the date you promised. You have to give it from the date when the policy is actually in force. So a lot of people make mistakes here. So if the idea is to grant ESOPs as quickly as possible, our recommendation would be to take a simple policy, get it approved by the shareholders. So your date gets logged in, and your shareholders in the beginning could just be the founders and so on. But there is a record of the resolution. There is a record of acceptance of the plan. You can start giving grant letters, and then when the company matures, you can basically amend the policy if it's required. So if you don't want to go through a complex policy in the beginning, just get a simple policy which covers most of the common things and get a date logged in, So
Just
Sorry, have you forgotten to share your screen or something?
okay, sorry, I didn't realize. I didn't realize that at all. Can you see it now?
Yeah, we can see. Oh, yeah.
Just to add to that, Satish, I think, there is a minimum 12-month cliff for ESOP, the first vesting to also happen, right, under the Companies Act.
Yeah, I'll talk about all of that.
Okay.
What I'm saying is the date of grant. So like you guys know, ESOP goes through 4 phases, right? There is a grant, there is vesting, there is exercise, and each one of them has specific meanings. So when we say you are giving a grant to somebody, it just says on this particular day, you've been, granted some options. How they convert to shares and all that is the vesting schedules and so on and so forth. I'll come to that. But essentially what I'm saying is it's a legal document. So without a proper approval, it's not live. So you cannot give options to anybody before the day of approval of a ESOP policy by shareholders. So this is a critical thing. And just to kind of tell you who all are the regulatory bodies that you will run into, obviously you've got to be Companies Act compliant. You have to be FEMA compliant. For those who are going to list or near listing, you have to be SEBI compliant. And there is the Income Tax Act, that's on top of it. There's a bunch of other compliance rules which are all covered under the Companies Act. But these are largely the 4 bodies under which you have to make sure your policy is secure. The choice of instrument, ESOP is not one instrument. When we talk about ESOP, we generally mean that it is a mechanism of reward that is connected to a company's share price. It could be ESOP, which is what the default thing would be. It could be a share stock appreciation right. It could be phantom stocks. Phantom stocks, just as the name means, they're not real stocks, but they mirror stocks. And there is RSUs, restricted stock unit. RSUs are not a legal entity in India, but still people freely use the term. So I just kind of kept it there. RSUs is nothing but some combination of, ESOP and, with some specific structures in place. And again, one of the most important things to understand is not every stock option settles into stock. It can be settled as stock or it can be settled as cash. And I'll kind of explain the differences later. But it's simple enough to understand that if it is cash settled, you will never receive shares of the company. You will receive shares, you will receive money, which is equivalent to some value of the shares of the company. And if it's stock settled, once an option gets vested, it has the ability to get converted into a stock. And only if you hold a stock, you become a shareholder of a company. There are a bunch of things that are important. Strike price, vesting schedule, excess terms. I'll run through all of them. There's some governance issues in terms of who governs and administers. I'll cover that later. And also remember, stock options are not free for the company. The founder is diluting. Some of the early investors are diluting to create this pool. And at the same time, stock options value actually need to be booked as expense. So it will impact your P&L. So it is a paper expense. It's not money that you're spending, but it comes on your book and it will impact your P&L. Again, important when you're trying to look for profitability in the later stages, but we'll kind of get to that. So legal structure, the simplest rule in India is for ESOP, for employees, give ESOPs. For consultants, advisors give SAR and Phantom, and even SAR and SAR in particular. The difference between SAR and Phantom is how the value is created. So in SAR, you get the difference in the strike price and what the sale price is, and in terms of Phantom stock, you get the full sale price. Again, I'll explain the differences later. There are a bunch of things that typically happens in the life of a company, which we call corporate actions. Like your stock may split because the price is too high. You may issue a bonus and so on and so forth. All cap table items, anything that impact the cap table will also have impact your ESOP pool. Not doing it will shortchange the employees. And also in some cases is not legal as well. So that's something that has to be taken care of. Ketan talked about cliff. So cliff is basically the minimum amount of time that an option needs to spend before it gets actually vested. So essentially, in the case of ESOP and in the case of India, legally we have a minimum of 12-month cliff, which means that if you join the company today, you cannot vest your options 1 year from today. And this is true for every single grant. So it is not connected to the joining date of an employee. It is connected to the joining. It is the start date of the grant. So let's say you joined on January 1, 2026, and somebody gave you a grant January 1, 2026. The first vesting will happen January 1, 2027. Now, in February 1, 2027, if somebody gives you a grant, the first vesting for that will happen on February 1st, 2029, even though you've been in the company for long. So it is not in the joining date of the company, it is on the grant date. So something that you need to keep in mind. The same thing is not there for SARs and other things. It's primarily there for ESOPs. And like I said, ESOPs are not free. This needs to be booked. And for that purpose, you need to value the ESOP, and you need to value the ESOP frequently. If there's nothing going on in the company, you've got to do it at least once a year. If there's financing going on, valuation changing, and so on, you probably will have to do it more than once. Again, some red flags. Please don't download policy documents from random websites and use it, even though the random website could be as popular as Y Combinator. The US plans don't make sense here. A lot of founders, we always hustle and try to save wherever we can, right? So ESOP policy, in most cases, are given to you, reference policy is given to you by investors. I think YourNest also gives a sample ESOP policy that you could adopt. But please don't go to a random website, no matter how popular they are, even though they are a law firm, don't download and use it, unless it comes from somebody within your own ecosystem, because generally there are things that are missing in most policy documents that come and bite you later on. Make sure all the document trails are kept, because whenever there is a due diligence done, you'll need to make sure that you have the board resolutions, the shareholder resolution, the policy documents, the grant letter formats, everything in sequence. So don't do that as an afterthought. It's very simple to maintain them. Accounting, again, most of you may not have a CFO or a VP finance or somebody senior in finance. Lean on your investors to kind of give you some help in this area, because sometimes if you do incorrect accounting, you may end up in trouble. Fractional options, India doesn't support fractional shares, so there's no point in providing fractional options. You can provide fractional options, but the time it gets converted to shares, it's got to be converted into a whole number. So there is a little bit of math and there's a little bit of employee education needs to take place. If you can avoid it. If you cannot avoid, then be aware of the fact that something needs to be done when you actually exercise fractional options and convert them into shares. So strike price. This is a very important component of any options, right? Because the strike price is basically means what is the cost of these options. So what does an employee pay to acquire this? The general thought process is that employee doesn't pay anything. and which is incorrect both legally, financially, and you got to get your heads around this, right? The strike price, every country has got a whole bunch of laws in terms of how some of these security instruments can be given. Now, in India, thankfully, we can provide ESOPs at the bare minimum value, and the bare minimum value is equal to the face value of your equity shares. So many of you may have incorporated the company with 10 rupee share, 1 rupee share, or whatever. So that becomes the bare minimum. Because it is so small, generally people tend to think it's free, and which is a good way to think about it as well. But technically, it's not free. And why this is important is primarily because when an employee joins you, if you give somebody, let's say 100 options, and your face value is 1 rupee, essentially at the time that they have to convert these options into share, they're actually paying 100 rupees. But your share price when you gave it to them could be 50 rupees. So they are seeing 5,000 rupees in 100 into 50, just 5,000 rupees in value minus the 100 rupees cost. So they're seeing 4,900 rupees in value the day they join. This is what we call in the money. You are in the money from day one. It's really, really important, because when you look at generally people tend to think, why should I compensate somebody for value that is already generated in the company? I will compensate someone for the value that they are going to help generate. Well, conceptually, it is okay that if I come in when the company shares are 50 rupees, and when I exit, it's 120 rupees, I should get 120 rupees minus 50. That's the value that I helped create. Well, conceptually, it works. It is a problem when you do compensation accounting, because we are already struggling with high cash burn, low cash, struggle for funding every 9 to 12 months, and so on. This serves as a good instrument where employees now don't need to look at the value from the time they join, but they are in the money already. And it's not fair as well, because from a compensation structuring point of view, you will realize that maximum value can be generated if you're able to let people come in when they are in the money. Some people look at FMV is fair market value, which is very simply put, what is today's market price. A lot of people do it at discount to fair market value, and that's not a bad idea at a later stage, where at least you are partially in the money. So let's say, same example, 50 rupees, I give it to somebody at 25 rupees. I've given them 50% discount. So they are in the money for 2,500 rupees, rather than 5,000. So it is still better than nothing. So a lot of times this is followed when you are either a listed company where there is liquidity is not an issue, or when you are very close to an IPO. So then you can say, okay, I know the value creation. I can predict the next set of share price changes to some extent, and thereby the outcome is a lot more guaranteed than in an early stage startup. Giving it FMV, we believe, is a bad idea, because it doesn't take care of one, you have nothing when you join the company. Second, market can move up your valuation up and down. If the market goes down, then an employee is now losing money, and he'll basically say his option is actually, it's worthless, is a is not even the right term to use. I'm negative, though I will not lose cash. I'm sitting on an asset which is negative, right? And trying to reprice that because the market has changed on you is a fairly complex activity. So these are generally the three use cases for strike price. We always recommend giving it at face value. If you are closer to an IPO, then start to look at giving it at a discount. Now, there is one small complication that happens when you have companies in multiple jurisdictions. You could be headquartered in India, but if you are in the US, you cannot give a US employee at face value, even though it's an India share. So I will get into it. There are some complications when you go, when you're expanding beyond India. different other countries have different rules. US in particular has this stuff that you cannot give it to them at less than fair market value. But I'll also explain what the fair market value means in that sense. So it's not as bad as the market price, but it's still, you cannot give it as the face value of the company. Sometimes you don't realize you end up giving it because you want it uniform for everybody in the company, and that creates a problem. So as the previous question that was asked about vesting, strike price, and all of this, these are all items that you can vary on an employee by employee, though we don't recommend you to do it like that. Try to keep everything standardized, but there is nothing in law that tells you that what you give one employee has to be the same as what you give another employee. Now, whether it is strike price or it is vesting schedule. So vesting schedule, what is the vesting schedule? Vesting schedule is basically the way you start earning these options. When somebody grants you these options, you haven't earned them. You only earned the right to convert this into shares on some interval or some events. So the default playbook has been about 4 to 5 years. If I give you 100 options, they will vest over a 4 to 5 year period. And they vest equally, 25%, 20%, largely time-based. Sometimes they are milestone-based, or sometimes there's a combination of time and milestone. These are generally the default simple cases. If I were doing a Me Too company, then you would lean on this. Now, there are some exceptions, right? And these exceptions are when you look at the type of company that you are building and what does it take for value to get created in these companies, then you'll have to tweak all of this. And typically in deep tech, in the area that most of you guys are, generally 4 year means nothing. And again, there's a history to this 4 year thing, right? This 4 year and equal vesting and all this came from the Silicon Valley world, where it would take 5 years to build a company. So generally people said, I want to make sure that people stay here for 4 years. I'll spread it across 4 years. And 5th year, I raise a mezzanine round, and 6th year, I'm going IPO. That world is gone. But unfortunately, this has remained. So you will see a lot more variance in what you see in India. One, some companies long gestation period, some companies takes long time even for the employee to generate value. And that's why we see in deep tech companies, we recommend more like a backloaded vesting. It could be 10, 20, 30, 40, it could be 5, 10, 15, whatever, depends on, your stuff. Even a public company that is as large as Amazon does backloaded vesting. But general thing is, think about the vesting a little more carefully, and please don't do front loaded. If you have 100 shares, just because you're under pressure to hire the employee, don't say 50% is going to vest in 1 year. It's extremely difficult to claw back options. Either do equal or backloaded, do 5 years or do 4 years or 5 years. There are very specific exceptions. You may be doing bonus grants, you may be doing high performance grants, and so on and so forth. There you can do a short stuff. But again, the assumption is that the quantum is also going to be a lot smaller compared to the one-time grant that you give. ESOPs, Ranjit brought up, it's an exception. There are really no rules. Many times it is constructed. If you're a non-promoter, you will still come under the ESOP umbrella. But generally what happens is, to make administration simpler, if you have let's say a 10% ESOP pool, 3% is reserved for ESOPs. So it kind of makes administration easier, but largely the rules remains the same. But if you are not in a position to provide ESOPs, because these are promoters and directors with 10% holding and so on, then you actually do share allocations to them. It could be through partially paid shares. It could be through some other structuring stuff where technically you're giving more ownership, but it is not through the ESOP route. And that has to be constructed, using a law firm, discussion between yourself, law firm, and your investors, and make sure that you arrive at something that works for everybody.
Sorry, Satish, what was the backloaded vesting again? I think either I.
Okay. So, so generally when you do vesting, you spread it across the vesting period, right? So let's assume the vesting period is 4 years, and you have 1 year cliff. So what you can do is you can say 25% you will earn at the end of year 1, 25 at year 2, 25 at year 3, and 25 at year 4. So in 4 years, 100% of your options have now been earned or vested. Now, this is what we call equal vesting. When we say backloaded or front-loaded, you don't do 25, 25, 25, 25. So an example of backloading is you get more towards the end. So it is like 10, 20, 30, 40. So if you look at it, in the first year, you get 10%, second year, you get 20%, and the third and fourth year, you get 70%. This is what we call backloaded vesting. And front-loaded vesting is the reverse of that. If you do, some other scheme where in the first 2 years, you're earning a lot more, and the last 2 years, you're earning less. There are very few companies who do that front-loaded for mostly to do with accounting reasons in listed companies. But largely in India, you will see equal vesting or backloaded vesting. Did that explain?
Yes, thanks.
Yeah. So, any other questions on strike price and vesting schedules?
I think a question that came from Cargo FL team on that, can you have different vesting schedules or right, both in terms of tenure and the percentage for different people in the same policy?
Yes. So
Dipesh,
strike
that's what the
price.
question, right?
Yes.
Correct.
That was a question.
I thought I answered that. So strike
Yeah.
price, vesting schedule within the same policy can be different for different people. And again, see, a lot of this has got to do with why are you doing it, right? My recommendation everywhere would be don't do it randomly. Don't do it randomly because you have hiring pressure and so on. If you really believe this needs to be done, then document and do it. I would rather say make sure that you have a policy that would cover 75% of your employees and about 20 to 25% of the employees, wherever exceptions needs to be made. Go ahead and make the exceptions, staying within the umbrella of what you can do. So the umbrella in terms of strike prices, you cannot go lesser than face value. You cannot go lesser than face value if you are an Indian employee. If you are a foreign employee, make sure you understand what the rules are in that country before you make that decision. In terms of vesting, keep a default vesting schedule, which is 4 or 5 years, equal vesting, backloaded vesting. If you have special cases where somebody has to be treated specially for whatever reason, then by all means go and do it. If you have special grants, which are given as bonus grant, which lasts only 1 year, which you want to last as 1 year, just want to motivate somebody, by all means do it. But treat that under a specific umbrella rather than doing randomly.
Yeah, Satish, one more question. If you can go back to your previous slide on the face value. Yeah. So this face value that you have here, right? So let's say the ESOP policy we put into place after our funding happened. So when the company started, we didn't know much about ESOP. So we didn't put an ESOP policy at that time, right? ESOP policy came into existence, let's say after 3-4 years when the company got the funding.
Correct.
So the face value will, when the face value at which the ESOPs were allocated, will it remain same as the face value when the company was opened, or is it a different?
No, the face value will remain the same. This is the face value of your equity shares. The only thing that will change the face value of your equity share would be if you do a stock split or a consolidation.
Okay.
Your funding comes in and they're all preference shares that come, right? And those preference shares will have a face value of their own. When we talk about face value in the world of ESOP, it's an equity share. So I should have explained. I thought it was would have been clear. See, ESOPs converts always into equity shares. Okay. And in an Indian company, largely you have only one class of equity shares. Even though you can have multiple classes, for all practical purpose, you will have only one class of equity shares. So that class of equity share, when you incorporate the company, you will put a number to it. Usually it's 1 rupee, 10 rupee, whatever.
Okay.
So that number stays throughout the life of the company, unless you do a stock split or a stock consolidation, where the activity itself is to reduce or increase the face value, and that is a captable activity. That's why I said one of the items that I had mentioned was the corporate actions would have to take care. If there is a corporate action that takes place, you have to take the impact of that has to be considered in the ESOPs as well. But that's more from a compliance perspective. But as far as you are concerned, the face value of the share when the company started is most likely going to remain the same through multiple rounds of funding, unless you do a stock split.
No, makes sense. Okay. Okay, thanks, Satish. Thank you.
Cool. Okay, I'll jump to exercise. So what is exercise? So exercise is the process in which an option gets converted to a share. And again, remember, this is something that you guys may understand, but your employees certainly would not understand. They will equate options to shares. So whether it's HR teams or founders, you've got to take the effort to explain, saying, hey, this option gives you a right to get a share, but it's not a share. So the process in which you earn an option is called vesting, which is connected by time or milestones that we talked about. And the process of converting an option into a share is called an exercise. Now, exercise is a key item here, right? And why is exercise important? One, from an emotional perspective, the time you exercise is when you become a shareholder. Until then, you are an option holder. Though from economic perspective, you have everything captured, but you are still not a shareholder. And because you are not a shareholder, the shareholder rights that could be assigned to it, whether it is information rights, voting rights, whatever, they will not apply to you. Now, for an employee, it's not super important at an early stage to figure out whether I am an option holder or a shareholder. And the reason is, and generally people are taken back when I say that, saying only if you're a shareholder is your holding guaranteed. Though which is technically correct, the process of converting an option into a share is fairly complicated from a perspective of tax and governance. Now, I'll tell you what the problem is. Let me just quickly go to something and then I can. Okay, I'll kind of explain something which I thought I'll do it later. But so if you see this graph here, right, you will see on the x-axis grant, exercise, and sale. So the journey between grant and exercise is what we call the vesting. So let's assume you had 100 shares, and at the end of 1 year, 25 shares got vested. Now, if you have to convert that into shares, you will run an exercise process. And the exercise process follows a bunch of things. One, you pay the strike price. So in this case, if the strike price was 1 rupee and I had 25 options that I want to exercise, I will pay 25 rupees. And now that means I've paid the company 25 rupees and the company can now issue me the shares. And till here, there is no problem. Company will collect the capital, give you the shares. Now, the taxman obviously thinks that, hey, this guy has been given some valuable component here. Let me go and see if this can be taxed. And they will look at what is the actual fair value of the company on the day of exercise and say, if the value of your share on the day of exercise is 25 rupees, let's say, or 26 rupees, just to do the math simple, 1 rupee is gone in the strike price. I have 25 into 25. 625 rupees in my hands is treated as income and I am taxed, even though I don't see any cash. This is by far the biggest component of exercise that people don't come to grips with. You are being taxed when you have not made any money, right? So what is the value of this whole purpose of exercising? So which is why, and this is called the perquisite tax, and this is taxed as income for you. So the tax department thinks 625 rupees additional income is given by the company. So let me tax this on the slab you are on. So if you're earning well and if you're in the highest slab, you can end up paying crores of tax if you're a senior employee. So from an employee perspective, this is extremely negative, saying I'm not getting any cash, but I'm having to give so much cash as tax out. This is the fundamental reason why people do not allow you to exercise. Now, a lot of times when you read material on LinkedIn or outside, people generally say, oh, ESOPs are taxed twice. It is not taxed twice. The right way to understand it is a two-step tax. First step gets taxed when you exercise, and the second step gets taxed when you sell. And when you sell, what gets taxed is the difference in the price between the fair market value at exercise and sell, not from the beginning. So the tax is broken down into two components. Unfortunately, even if you hold the stock for a long periods of time, not the entire value gets captured as long-term capital gain. The time you exercise, that gets captured as income, and from the time to exercise to time to sell gets captured as capital gains, whether it's short-term or long-term, depends on when you sell. Now, I believe this is something that you will need to understand really well, because employees come in and ask you, why am I not allowed to exercise options? Because I want to be a shareholder. I've spent time in the company. My options are vested, but why are you not allowing me to exercise? Now, this is the explanation that you need to provide of, this is the tax bill that you have to do. And this is the cash that leaves you when you are not seeing any cash in your hands. And this is the reason we don't, exercising options is not beneficial to you unless you know that there is sale happening tomorrow. And when I say tomorrow, literally tomorrow. So I would like to pause here for a minute, because this is the concept. A lot of people get confused. So if there are any questions related to this.
Yeah, I want.
There was a
Sorry,
raised
Monu.
hand I pushed earlier.
So there was a question in my mind, is that what happens if the person doesn't exercise at the time of, let's say, at the end of 1 year? I am confused about this. Does that option gets lapsed also? Is there such a thing?
Yeah, no, I'll cover that. The reason I jumped to the tax thing was a lot of these questions are intermingled. I'll cover the life time of the options. I'll just quickly go back and cover that, but just hold that question for a minute. I'll answer that.
Sure.
I don't know again whether this is the right stage to ask the question, but let's say there is an employee with, getting about maybe 10 lakhs or 15 lakhs worth. Let's say they've not exercised, okay, but today they want to exercise and sell tomorrow. That means you need to first get your, you need to pay tax on the 20 lakhs first.
Correct.
And then get the money out.
Correct.
How do they actually practically do it?
Yeah, when I come to liquidity, I'll cover that exact steps that happens there.
There was another raised hand by Pushpavati.
Hello, hi Satish, this is Pushpa here. I just had a doubt when you're telling that ESOP allocated to be at face value. I have doubt if ESOP allocated to trust, it should be at face value or it should be at fair market value.
Okay, so trust is a very different item. I was not intending to cover an ESOP trust because it's a little more complicated. I don't know if have a lot of people set up ESOP trusts?
We do have trust, so I just had a doubt of this because if we allocated the ESOPs at face value, or it should be at fair market value. Okay,
no, there are a few more things connected to that on the trust. I'll probably take it towards the end, or you can reach out to me offline. Because trust, there's a bunch of things that have to go along with this. There is who pays for the shares, how much is actually paid. How do you manage beneficial interest of employees? What is the role of a trustee? There's a bunch of things related to trust, which I wasn't going to cover because I thought nobody would have set up a trust. But I'm happy to take that offline. And I'll walk through it.
Sure, sir. Thanks a lot. I'll just connect you on offline. Yeah. Thank you.
Okay, so one of the key components of exercise is there is a perquisite tax. So perquisite tax is a deterrent, and for the reason that I mentioned. So for an employee, it does not make sense to exercise in most cases, and I'll come through the exceptions. There is also a governance implication for the company, and this is something that you as founders need to understand extremely well. Because generally, I have spoken to founders who have the best intention in their heart that they do want to make employees shareholders, but there are some extreme governance complications. See, once somebody becomes a shareholder, then you have some protections under the law, and these protections can also become a governance problem or can be misused. Normally, whenever you see shareholder disputes, a lot of it is got to do with, you will see some remnants of what happens here, right? So the most common thing in terms of an employee owning a share is two things. One, if the employee leaves and joins a competitor, you now have somebody in your competitor's office who is your shareholder and literally will have some rights, however small they are, some rights, some information rights as far as the previous company is concerned. So you ideally never want that, because these are not listed companies. There is benefit into keeping disclosures to the outside world minimum. You are building something privately, and the law gives you protection of what needs to be kept private has to be private. So you don't want a situation where an employee shareholder is working for a competitor. Second, where it plays out very negatively is when it comes to certain merger acquisitions type. The buyers sometimes insist on 95%, 99% shareholder approval for certain transactions. So let's assume, you are a company A, you've got an offer, a large company to acquire you. Now, the acquirer does not want a lawsuit after the acquisition takes place. So one way to protect that is get okay from all shareholders, irrespective of how small they are, right? Now, this employee who is a shareholder who may have left the company, you don't know where they are. Number one, they may not have any bad intentions, but you may not be able to reach them because you don't know where they are. Number two, they may be in a state where they may not cooperate. If not anything, they may just take more time than required, to come and participate in some of these events. So there are some governance stuff where when things go bad, we've seen it really go bad. So if I look at the governance requirements of a company and the perquisite tax, on the employee, for both parties, it makes no sense. That is why we generally say, don't randomly allow exercises. Make sure that this exercise is something that you really control. And whenever you write policies, things on, when can somebody exercise and so on, defer all the powers of this, not inside the policy, but to the board. So that way the board can take a decision at different points in time, depending on what is, good for the company. So this is kind of really important. In the US, it is not serious. So a lot, which is why I mentioned back to Y Combinator or any of the popular ESOP plans, you will see pages and pages of how to do exercise process and all that. Please don't adopt that because what you do in India is very different. And the US stuff is very different. So from both parties, whether it is for the company and the employee, we don't see any solid reason to exercise because the pains are significant. But please understand that, make sure that your HR teams understand when it comes to explaining it to employees, if it ever comes to it. Now, if you're a DPIDT startup, this perquisite tax liability can be deferred for up to 5 years or 7 years, some number I don't recollect now. And it's possible that, again, your employees may come and say, hey, I don't have to pay perquisite tax because it's deferred. But there is a problem with that. That's a pretty useless feature that the government has given us. That thing breaks moment you leave the company. So if an employee leaves the company, then the tax is payable right at that point in time. Now, and many a times employee may believe that they may not leave the company, but think of the use case where the company may let this employee go for whatever reason, right? Even in that case, now the perquisite tax is payable by the employee the day the employment ceases to exist. So they have given a feature which nobody in the country has used, and it's a practically of no use. But it's important for you guys to understand, so you can explain it to employees, should it come to it. Now, the question there was on the, what happens to the life of these options? What happens if I don't exercise? So normally, whenever you build a plan, there is something called the term of the plan. So the term of the plan tells you for how long an option is active and how long a plan is active. So normally your option life is equal to the life that is mentioned in your plan. And almost all of the people say this is a 10-year plan. Means this option plan exists for 10 years. If required, you can amend it and increase the number of years. So the problem that comes is what happens when an employee hits a vesting event now, and the company is not allowing you to exercise. Now, if the company is not allowing you to exercise, or you don't want to exercise because of tax reasons, as long as you are employed in the company, these options will stay for the duration of the plan. So these options will never lapse. They will technically lapse on a particular day, but most often what happens is the companies will extend the life of the plan because you don't want any existing employee to lose any options. So normally it is extended if the term of the plan is closed, but it is fair to see it from the eyes of, if you are employed in the company, then these options do not lapse at all. Now, what happens if you leave the company? Now, if you leave the company, generally this is called as a PTEP, or the post-termination exercise window. Most companies give you a specific time or a condition that you have before which you can say, I will want to exercise the company, exercise the options, or these options will lapse. Now, here is a problem, right? The industry standard time frame is 3 months. And this again came from a tax rule in the US. And US, it used to be 3 months for a long time, where they said, if you leave the company, you will lose your options if you don't exercise in 3 months. And because your tax bill is so high, you will not exercise. And because of this, you will not want to leave. So it kind of became an indirect retention tool, right? But what has happened is almost everybody in the industry for the last 5 years have recognized that this is a bad policy and it's not employee friendly. So US is, and in particular Y Combinator, has gone the other way. They've said, let's make it 10 years. That anybody who has got, who leaves the company has got 10 years to exercise. And if they don't exercise in 10 years, then, the company would have been dead. So there's no point in even exercising. So that was the logic, right? But we believe both of them are wrong. There is two alternatives that you can think of. One is give a variable window, and this variable window has to be carefully created. You can say, depending on how many years an employee left in the stayed in the company, I am going to give them that much amount of time. One simple formula, right? So if an employee stayed in the company for 5 years, you give them 5 years time. If an employee stayed for 1 year, you give them 1 year time. The reason this variable window works is it helps you kind of reward loyalty, even though the employee is not left, and you will keep the options open, hoping that some liquidity event will happen. Now, another way of looking at it is, don't expire them until a liquidity happens. So if the company is willing to provide a liquidity event of some form, so a liquidity event is essentially letting you convert cash, right? And now that's fair enough to say, hey, I've given you an opportunity to convert it into cash. If you don't take it, it will lapse. So then the company is also fair in saying, I've allowed you a mechanism to get some cash, whether you're an existing employee or a ex-employee. And if you don't want to take it, your options will lapse. So these are the two models we see. You have a variable window, or you don't expire until the liquidity happens, or you use some sort of a hybrid. But anybody who's doing 10 years or 3 months, I personally believe it's not very optimal. So long story short, if you are employed, your vested options remains employed. If you leave the company, then you will have either time or connected it to an event. In some cases, even though you're employed, there may be a liquidity event that may force you to exit. For example, a company that's going IPO or company is doing some restructuring, they may not give you an option. And they'll say, hey, we are cashing out some of these options. Please take this offer. And a lot of times, some of these things cannot be anticipated. That is why all of these conditions, we don't recommend that you try to think of 100 possible cases that may happen and draft them into the policy. Just defer all of this to the board. Since the board will, take a decision at the appropriate time. So depending on what happens, what event happens, then the board can appropriately decide, what could be the ideal scenario. So this is about exercise and expiry. Any questions? The previous questions got answered.
Hi, Satish. Could you also include buyback scenario here? Can you explain that too?
Yeah, I'll talk about that when I come to liquidity. Another 5 minutes, I'll get there.
Oh, all right.
So just quick note on what else goes in the policy. Just make sure, like I mentioned, corporate actions are included. There will be some, one of the key things with a private company is the company is private for a reason. You can't have random shareholders. So sometimes, even though you have a share, either because you've exercised or the company gave you shares or whatever mechanism, an employee cannot randomly sell. You will, and all of you founders are familiar with ROFR. Even ESOPs go through ROFR. Sometimes there are some things for M&A. Okay, and this is again, founders should think about what you need to do. You can leave it, blank, which basically means that the board will take a call. Sometimes there are specific acceleration clauses, and this again has to be done carefully. There's something called single trigger and double trigger. Single trigger basically means that whenever there is an M&A event, all the unvested options of the employee will automatically vest. Normally, this kind of stuff you only see in PE companies, okay, not in VC-led companies. In PE-led companies, where even founders are minority shareholders, very much small shareholders, they also have ESOPs and all that, and they want to make sure every equity shareholder is protected if the company gets sold. Because there have been enough cases where the company gets sold and the founders and employees get shafted, right? So sometimes you put in these clauses, but in VC-funded companies, we don't see it. And in some cases, you see double trigger. And double trigger we see in some of the cases. And double trigger basically means that if there is a company being bought by another company and the employees get laid off, so the two conditions have to trigger. That's why it's called double trigger. One is the company getting acquired. Second is the employee losing his or her job. Then all unvested options will vest. Again, this is a mechanism to protect people in the case of post-acquisition, activities. That's for companies at a very early stage. You can leave it, but don't put single trigger in a VC-based company. Then the acquirer will get scared, saying the whole idea was, if I acquire this company and everybody's options vest, why will these employees continue to stay with me, right? So I put it there just for completeness sake, but do it carefully. There are some behavioral levels. What happens if there is somebody who leaves in bad faith? There is fraud. Normally, we talked about vested options remaining vested until there is a liquidity event or a time horizon. In the case of a bad liver scenario, you basically extract everything back. So even the vested options get forfeited. You have to make sure this is returned. And there have been some corner cases in large companies when somebody goes on a sabbatical. Now, when you're going on a sabbatical, technically it doesn't constitute that you're working. So at these points in time, you may want to pause vesting if the vesting is time-based and restart vesting once they come back. There's some operational activities, trying to make sure that who's the administrator, is there a compensation committee, or is the board going to decide everything? Where is the governing law, jurisdiction, and so on? Things that would round off any agreement, make sure it's done here as well. A quick note on accounting. I don't know if any of the finance folks are here. Like I mentioned, ESOPs are a cost to the company. How you account for it depends on what kind of accounting standard you're following. If you're following, most of you would probably be in Ind AS. If in Ind AS there is one method, if it's IGAAP, there's another method. Expenses have to be on your books. There is a big difference between SARs and ESOPs. One thing that you need to understand is when you account for ESOPs, again, I'll skip the details. Anyone who is interested in knowing more can reach offline. There is a way in which you account it on your books. So in ESOPs, generally when the grant is given, you take the value of the company at the time of the grant and you do the accounting based on that. If you are giving SAR and a cash settled phantom stock, it is treated as a cash liability and it's always mark to market. So mark to market basically means that your liability continues to increase, as the company is growing and your valuation is growing. So what appeared like a small number on your P&L will continue to grow as a cash liability if you give SARs. That's why I mentioned don't give SARs for a large set of employees, very small number. So the number is small. So even though the value is increasing, the total impact on your cost will be smaller. And for all these purposes, you need to do an option valuation. Option valuation is not the same as what you do for merchant banker and other things for fundraisers. You will have to do what is called a Black-Scholes separate valuation, which is derived from this, but you still need to do that valuation to account. Your finance team would know it. If they don't, please rely on your investor, understand and make sure it is accounted for. One last very important point. I don't know if any of you here are headquartered in US or Singapore. If no one is there, I'll skip this section. Anyone on where the parent company is outside? Okay, I'll skip, but keep in mind if your parent company is outside and you are giving options to employees in India, there are a bunch of things that you've got to take care of. Even though all your employees are in India, you have to take care of some things. If your employees are moving, they spend some time here and they get transferred out and all that, all complicated stuff. You need to take some serious advice before you put something like that in place. So don't do that. Don't apply the India rules to the US and vice versa, and US and Singapore. US I wrote specifically because he's got some specific issues with US. I'll jump into liquidity and why are we talking about liquidity and why do people like us exist? Fundamentally, private companies are staying private longer. No longer are the times where in 6-7 years you can go list. So the median wait years is about 13 for an IPO and about 11 for an M&A. Essentially a long time. If you expect an employee to stay 10 years in the company and they are in their mid-20s to late 20s, life happens to them, right? By the time they see company going IPO, it's 10 years. They would have grown, families have grown, needs have grown, requirements have grown. And if you don't provide any liquidity, then this whole concept of ESOPs makes no sense. So all founders who are looking at ESOPs as a proper wealth sharing tool, don't see this as a one bullet at the end of 10 plus years where you will generate wealth. You will have to see it as how do I figure out a way to generate some periodic wealth. So what are the liquidity structures that are possible? There's a company buyback or cash out. And normally what happens in these cases is the cash rich companies, these companies may not be profitable, but they have a lot of cash, right? Take one of the companies that's been in news in the last day or so. Cred has done, one of our biggest customers. They have done a lot of buybacks, a significant amount of value, and all because they had excess cash raised from the VC community. The company is not profitable. So technically, it's not a buyback from a law perspective, but what they're doing is they have enough cash and they're using that cash to distribute it to employees. So the mechanisms is very simple. You basically cancel the options and you give cash instead. So it is taxed as income. You don't become a shareholder, but employees will see liquidity. Second model is exercise and sale. We talked about you don't allow them to exercise unless you are ready to sell the next day. It's essentially what we do as a company. We have a secondaries fund, which allows employees to exercise and then immediately sell, and we are the buyers. So essentially what happens is, you've got, depending on when the exercise happens, you have time to pay tax and more importantly, time to pay TDS. So you essentially wait for the buyer to give you cash and then you use that money to do your TDS, and eventually you'll account for it in your tax return and pay the rest of the income tax. And that is done multiple rounds. It's either done by a specialized fund like ours, or sometimes whenever a new investor is coming in or an existing investor wants to put more money in the company, along with the larger primary down, they will do secondaries. And the secondaries also is structured in a similar way, where you do some mechanisms by which the new investor comes in, gets a blended price. What I mean by a blended price is secondaries get bought out at one price, primary gets bought out at another price, but combined they get a blended price, but the employee gets some element of cash. The third model is exercise now and sell later. We talked about this. Why do you want to do this? You want to do this only if you believe that you have a lot more value to get captured and you want to pay long-term capital gains. So long-term capital gains tax is a lot lesser than income. So if you want to play that tax game, then you will exercise and sell later. Now we talked about two roadblocks to this, companies' governance issues and perquisite tax. So I will tell you what happens in both the cases. So like I said, to provide liquidity, you need liquidity providers. Who are the liquidity providers? Company, if the company is doing the buyback. People like us, we are specialized in ESOP buybacks. Other secondaries funds or large primary funds who do a primary plus secondary. The last one is ESOP financing. We talked about exercise and sell later, where there are companies who will lend you money to pay your strike price and perquisite tax. Now, why does this make sense? Why would you borrow money from somebody and pay tax? And this only happens when you have a clear visibility of liquidity. So if you know that you are going to go IPO in 2 years' time, which is the time that's required for us to get covered under long-term capital gain, you will probably consider this. Bajaj Finance, Nomura, which is Edelweiss before, all these guys are playing, they play in this game where they will lend you, once the board approves, then they will lend to the employee to pay this perquisite tax. These shares are pledged to the lender. And once the company goes IPO, you sell and then you repay the financer. So largely, these are the three models in which liquidity takes place. Now, the actual process, form, and everything, if you are working with somebody like us, everything happens on a digital platform. You really don't need to do anything. But if you're doing it yourself, then you'll end up hiring a law firm and going through the process. So there is a mechanism in which you do liquidity. our recommendation is everybody starts looking at doing some sort of a liquidity about when they get into a Series C timeframe, and do about 15-20% of employees' vested options. Because what you are trying to do here is you are allowing for some liquidity to happen to employees, but you do not want to do so much that the employee thinks, he or she is done here and leaves. So it's a balancing act. So we help, when we onboard these companies, we help them arrive at what is the optimal number, looking at what the company structure is, what the people are, and what the cap table constructs looks like. So it's a complicated step of doing some liquidity, giving them additional options, figuring out a price, and so on and so forth. But I can now say we are the first ESOP focused fund in the country, and the idea is to make sure that this 10-15 years time frame that you have for employees is compressed, and the founders, some pressure is taken off of the founders, because one time you can fundamentally think of it in saying, why do I want to take external capital? I'll do it on my own, because when you are racing towards IPO or any large event, you are focused on profitability and other things. So you do want to make sure that your focus remains on that. And a regulated fund coming in and doing this is very different compared to employees being allowed to sell people to randomly. Now, private companies, they can't sell, but your other alternative was, if the employee comes, you could say, hey, you go find a buyer and then I'll help facilitate. So it's again, a very dangerous thing to do, because you don't know who is coming on board. If it is a company facilitated tender offer where a fund like us comes or some other regulated entity comes, then you know who's on the cap table, what the governing principles are, and so on and so forth. So we don't recommend providing liquidity through any random individual, even though it could be a HNI. We would say just, either company look at providing buyback yourself, or look at existing investors who are already on the cap table, or look at a specialized fund whose job is to do this. Don't settle for anything in between. Any questions on liquidity so far? So the previous lady who asked the question, I'm not sure if that got answered.
Yeah, it did.
Okay. Cool. Last part, administration, education, and so on. This is something that usually people neglect, but I would really request founders to spend a little more time. I'll quickly run through things that I found very useful. The fundamental thing is an Indian normal employee does not understand ESOPs. They still see it as paper value. So the onus is on you as a founder or as a company to explain. And it goes a long way to start using software and tools, rather than seeing this as legal documents. So those of you who are managing on Excel sheets and other things, because it costs you, I would strongly recommend that move to our platform. And again, shameless plug, given that we're all part of the YourNest family, you should use our platform. Cost is not an issue, but it will take a lot of load off you guys in terms of trying to explain what this is to the employees. And also train your HR rewards team, whoever is dealing with them, let them understand. I'm still shocked to know how few HR people really understand ESOPs, and also make sure that you prepare a set of documents or some sort of a set of things that you can share. And again, Ketan can help you put all of these things together. Make sure that your letters are well done, the policy summary is created. Anybody whom you're potentially hiring, obviously you don't want to share these legal documents with them, but you can share a summary saying how is this a better, like a employee friendly version compared to something else. If it is not, yeah, it is not. But if it is, then please share a summary. Give them calculators and visual aids, and a lot of this is available on our platform. If you use the platform, But it's more of what we've seen is people who have not yet joined, you do want to take some time to explain some of these things to them. If it is employees, transparency is key. Make sure you have a detailed employee handbook, which has got everything, all the explanation, FAQs, conduct as many webinars as you can. There are people like us who can come and help do it. If there's any specific clarification and other things required, please help them understand. Also, the software is not just for you as a founder or administrator. The software is for them as well. Allow them to also take a look at, what is going on inside the company. Let them transparently see the value. The hardest part is, ESOP is still paper value, notional value. So on one side, you want to over-index on what value you're creating. At the other time, you want to be able to set realistic expectations. Because depending on the financial maturity of the individual, you can prevent a lot of issues if this is done correctly. Because people just don't understand. So sometimes you have to keep repeating that, this is where you want to become like a SpaceX, but the worst case outcome is 0. So it's very hard to have a balanced conversation, and everybody gets better with practice. So my suggestion is kind of start practicing. There's no other way to, do this, because on one side, you do want to let them know that this is of supremely high value. At the same time, you do want to let them know that this is not guaranteed. And it is their part as well to help you get to that point. So some specific tips I've put together depending on whom are you trying to hire and who needs to be facing these people. And I've kind of, if you look at the founder call stuff, I think first 10 key hires is absolutely founder's job. Don't offload this to anybody. Don't delegate this. If you are hiring people who are coming from big companies, who have tasted ESOPs, again, I would recommend the founder does it. The senior leaders, though, obviously it goes without saying. But each type of person, there is a different concern. Though the financial and the investment literacy in the country in an average individual is improving, it's still, ESOPs is still a complicated activity for them to understand. So double down on some of these things. Wherever required, founders spend time. Use your investors where applicable to help as well. But nothing like the founder doing it himself or herself. And I would kind of summarize everything in one slide. I think there is something about being a shareholder of a company, and beyond all the commercials, I personally feel ownership is a privilege. So you are part of, you're owning something where, the outcome of all of us put together, creating something, and you get some sort of a satisfaction in terms of being able to create is extremely high. And though the commercials will follow it, but the non-commercial articulation is extremely important, because I've fundamentally learned in my life, if somebody joins you for money, only they will leave for money. So there are other things that you've got to look at where, you are part of a value creation journey. You are creating some value. Somebody else together with working with you is creating value for you. And it's really supremely important that employees see this, because we've seen one of the biggest things in the startup world is every successful startup goes on to create many more companies. And a best real world example that I can tell you is of Flipkart. All of us know that there is a Flipkart mafia. Flipkart outcome was extremes. Everybody made a lot of money and so on. But one thing that has completely gone unnoticed is if you take a look at all the founders who came from Flipkart and all the companies they built, look at how many of these companies have provided ESOP liquidity in the companies that they have created. Over 95%. And the reason they've done it is Flipkart, even before they got acquired, they created periodic liquidity. Obviously, you can say there was money and they could afford to do it and so on. But the cultural fallout of that is all these entrepreneurs who are employees who got benefited with periodic liquidity, now that they have become founders, are making sure that they are creating liquidity, for their teams. So there is nothing better than this to explain the ecosystem effect of how some of these things play out. So it's really, really important that you consider at some point in time. Don't do, I'm not one for suggesting that you do liquidation very, very early, or you need to do it every now and then. Once you get to a point where you think the company is growing, your product market fit is achieved, you have a revenue model that is working, you have a path to profitability, then look around and see, can you provide some sort of liquidity for the people who have stayed with you? And that's an extremely powerful action that you can demonstrate. So I'll just end here. In my mind, if there's an ideal ESOP plan, this is how I would do it. Up to Series A and Series B, follow a certain path. If you're late stage, and as you get closer to listing, and once you get listed, then a lot of things becomes predictable. So you can change the policy as you go along. And if you notice this, the policy is changing in very specific points. What happens to strike price? What happens to lifetime of options? What happens to the way in which vesting does? As the company gets mature, you will now begin to have a more, more of a predictable call here, where the value in ESOPs now becomes more of a long-term incentive rather than a massive, wealth creator. Though some of the listed companies, don't get me wrong, listed companies do massive value creation after they list, but by and large, the risk is so much before listing, is that you want to make sure that the value creation opportunity is 100x, if not 10x. So many of you guys know about us. I run the fund and Hissa here. I'm one of the founders. Srini is the other co-founder. We're also a YourNest portfolio company. So we're all brothers and sisters here. A bunch of other investors. And that's about it. You guys know how to reach me.